Good day, all. Ira Epstein of Linn Associates with your financial market wrap-up, and this is for Wednesday, the 22nd of January, 2020, getting on now to 4:20 in the afternoon. We have a stock market that actually, while it finished here, and these are the settlement prices, it was lower than this in the last trades of the day. The markets are nervous. We have this Wuhan, I hope I'm saying that city's name right, and it's called the coronavirus. And that coronavirus, it's contagious. Both animals can give it to people and people can give it to people. Now, yesterday I had said there were 7 or so people that had died. Today it's up to 17. The cases yesterday were around 400. There's 540 known as of this morning. I'm sure that number overnight's going to climb on everything again. The Chinese have quarantined the city. Now, quarantined, according to them, means that they have taken it, be it plane or train, and those are the major ways that people get around in China for longer distances. You cannot get from the airports to the city or from the city to the airports, same with the train stations. Big problem. Cars, don't know what they're doing there yet, but I can't imagine that they're not going to try to limit travel. And the problem is this is their lunar holiday. This is their New Year's. And people travel. It's like Americans hitting the road for Thanksgiving. Big problems. The World Health Organization has people on the ground there. They're going to have another big conference tomorrow to tell us where they're at with it. I don't know that anybody's got its arms around this. We do know it's spread to Beijing already. It's in Thailand. It's in Australia. It's in Japan. It's in the United States. I don't know the other spots yet, but people move about, and it is contagious. It looks like the cold. But I think it's having its impact here. I really believe it's impacting the energy markets. As China, one of the world's largest consumers, we might see that people don't want to go to factories for a while. I don't know what to expect, but I've been surprised that the market wasn't more reactive to it, because if you go back to 2002 and 2003, when the SARS came out, you saw the problems there. When we come to the S&P, we're down for the week, minor, 5 points, big deal. You know, everybody's so used that every day is going to be a new high, the market gets too complacent. And you're running a big price-earnings ratio here. Earnings are going to have to come through to keep this going. I mean, there's only so long you're going to be at 19-to-1 or 20-to-1 price-earnings ratio. I'm not bearish. I'm just telling you, events happen. You're still very much in an uptrend on the weekly chart. Now, on this chart, this is a daily chart, should the market take out yesterday's lows, not today's. Yesterday's low was 33.07 and a quarter, and I bring that up because it's not that far away. You probably have made something of a distribution top. Remember, this break low is what I call missile day. This was the low that happened when Iran fired those missiles into Iraq. We didn't know what to expect in the market. Really snapped to the upside. So if you take out 33.07, you might go into a stall period at this point. Can that turn the market out now bearish? Well, if you believe like I do that you have in an uptrend or a downtrend, I'm looking for a pattern. In this case, I've got a higher high. So the worst it can do is a higher high, lower low. Where could support be? Well, I'm always looking at where the 18-day average of close is in relation to price. In this particular market, if we look, each time recently it's hit it, it's proven to be a support area even back there. So that's one of the areas that, in my mind, I've already got locked in. Doesn't mean it's a buy for me there as a technician, but it's certainly something on my radar scope. Markets don't stay forever against upper Bollinger Bands. Eventually they pull away from them. I don't know the day, I don't know the time, but I certainly know how to use slow stochastics. And until the red line closes under 80, you still have the pattern here where on the breaks the pros are buying. Get that under it, and then I look for prices to return to that 18-day average. It doesn't have to, but often that's the signal, and often momentum turns before price. This is not yet turned. In the Nasdaq, still a very bullish embedded reading, riding the upper Bollinger Band. If you lose the embedded reading, I'll look for wherever that 18-day average is to be a target on the downside potentially. But that wouldn't put the market bearish. You know, you'd have to get a certain pattern. You'd have to get lower highs, lower lows, a close under that 18-day average to get bearish. In other words, I can see correction material here. I don't know that I'm talking a top in these markets. In fact, I know I'm not at this point. In the Dow, we still have the embedded reading. Close under 80, that number. It's a warning sign, a big one, and I'll pay attention to it. In the Russell, you have not been able to embed. This is the weaker part of the stock complex. Yes, it's got a bullish reading. It's got higher lows, higher highs. It did for a brief period try to break out of this sideways action, got over the upper Bollinger Band, pushed it out a little bit, but it's so far come right back in. And all the market said, to me at least, is that this is too narrow. Is this the new norm? I don't know. I know the market's still in a bullish trend. It is overbought. You have to get these numbers out of 70 before I think the pros will step in as aggressive buyers. In the VIX, the market's running to that brick wall. What do I call the line in the sand? It's the 18-day average of closes. And when you're under the market, that could be an area that goes to the resistance. When you're over, it's often an area you fall back to, where the market tries to figure out what to do next. In other words, it's the neutral zone. In the bonds, I don't care what anybody says, you get up to the first challenge of the 100-day average in the upper Bollinger Band. It's where I think pros are taking money off the table. You're overbought. You're into an area here where it will take something big and fearful to make this go again to the upside. Right now, you're in resistance. Can it run? Absolutely. I don't know what's out there, but I know that as a chartist in a normal time, that's a pretty big resistance zone in the 10-year note. In the dollar index, the 100-day average of closes, not the upper Bollinger Band. It's this number that's had more importance when you look at the chart than the Bollinger Band. That doesn't take away from the Bollinger Band theory that the first time you hit it on the upside, I think pros come out. On the downside, I expect bounces away from it. That didn't change it. I'm just noticing that on this rally, that's acting as the restraining number, not so much the Bollinger Band. Whereas in the eurocurrency, you've got a pattern of a higher high, lower low. Now, if we look at this, this is a new low since December, frankly. So you're into the very beginning where the year ended, and you're challenging those lows in this market. In the British pound, you threw out a buy signal today in sideways action. I don't know that it has meaning. That's whenever you get this total sideways, it's churning action. But it is from this type of action that a big trend develops. The longer you churn sideways, the bigger eventual trend in the market. Now, you've got higher lows, higher highs, and you finished 131.56 over 131.10. In addition, momentum turned up. So I think the bulls grabbed control until the market gets back under 129.84. It's a heck of a risk. And I'm looking for, if it can mount a further attack to the upside, the 132.37 level to be the first resistance. In the Japanese yen, I don't pay attention to this chart pattern as much as I do to the embedded reading. Lose that red line over 20, and I think you're going to make a run to the 18-day average. Keep it the way it is. You start down again, and you could be, before you know it, if you get under this 90.93 into the 90.93 zone. I think the bears are controlling the market right now because of the slow stochastic being embedded. Bitcoin, you have an embedded reading. You know I'm bullish whenever I see that. So you've pulled back, but I still think the bulls are in control. Get that red number under 80, I'll change my opinion. In Brent versus WTI, look at this differential. You're up to 647. These are numbers we haven't been at in months. So the differential between Brent and the U.S. WTI crude, unbelievable. Now, if you look at them, they both have come down in price. It's the differential that's there. The market, remember we talked that 18-day average. This rally yesterday peaked there. You're immediately down from it. Now, I don't want to give you the impression it's a little. You got up to $66 yesterday. No trend. You have a lower low, higher high, first resistance. What did you keep? Did you have the embedded reading? Today, right back down. That embedded part is so important. I teach it in my charting course. Embedded reading here. So you're rallying in the market. It's sort of like the yen. That doesn't mean the yen is going to break. I'm just telling you I expect that momentum leads price. And as long as it stays embedded, I realize as this market's rallying, you're going, there it goes, uptrend, and I'm still bearish. Now, the first challenge of the 100-day in the lower Bollinger Band, what am I going to say? I have no idea what tomorrow's going to offer. I still contend that's where the pros are taking money off the table. Gasoline, same thing. So you had the gasoline rally, kept your embedded reading. I'm looking for prices back here. It's not a surprise. 100-day average lower Bollinger Band, but I think the pros are going to cover their shorts. And what do I think is causing this? I think that coronavirus has a lot to do with this. Then we get to the nat gas. Now, how many days are you going to spend under the lower Bollinger Band? You only spend 5% of the time under it. So you were under it yesterday, the day before. You finished under it. The day before the market finished 204.60, it was over it. So we have 1 day, 2 days in a row, and today the market finished under that as well, 3. You can go 4 or 5, but you're getting very close. Remember, you're looking at what I talk about with my morning subscriber video. Now, what do I mean by that? My morning subscriber video is where I put out all the meat and potatoes for what I think should happen. I typically wake up at 5. This morning I got up at 4. I wanted to read about this virus that's going on, and I got my whole morning done. By 5, I had nothing to do. I waited to 5:30 and began recording. In my morning video, I'm going to cover 40 futures charts for you. I'm going to talk about the markets, what has been the action in Asia, Europe coming to America, what are the day's reports. So in each video, I highlight the coming reports, be they come out at 6:30 in the morning, 7:30, 9, whatever the market's looking for, you're prepped. I'm giving you what the estimates are, if I can find them, and I typically can. How's the market looking? What's it going to do? And I'll be specific. There's more studies on it than here because I'm going to say buy here, sell there, do that. I give you a prep job for the morning. If you haven't tried it, try it. Go to our website at www.iraepstein.com under the word research. You can read about it and try it. It's $7.95 for 30 days, no contract. I will throw in free my brand new product, the Spider ETF video, while I'm getting that product ready for its subscription price and rollout. That's going to be in February, so you get double the bang for the dollar. I'm Ira. You have a good day, and I'll talk to you tomorrow.